Hello and welcome to the second episode of our new monthly podcast, Market Matters. Each month we'll be bringing you big picture insights from leading investment specialists exploring the opportunities, challenges and potential threats shaping investors' portfolios now and into the future. Our guest today is Jasmine Yeo, co-manager of the Ruffer Investment Trust, which aims to deliver consistent positive returns irrespective of market conditions. Jasmine joined Ruffer in 2017 and has extensive experience in wealth and asset management. Jasmine, thank you very much for joining us today.
Thank you for having me.
So starting with that topic, could you talk us through your background to becoming a fund manager and any challenges you might have faced along the way?
Yeah, absolutely. And you've already stolen my first line joke, because I was going to tell you that I joined Ruffer in 2017.
Sorry.
We've covered that. Yes, how did I become a fund manager? Well, I didn't know what I wanted to do at university. Someone mentioned something called a spring week. I had no idea what that was. Apparently it was a week you could go spend in a bank and learn about financial markets. So that's what I went and did. And I really fell in love with it. It felt like I was going to get paid to know what was going on in the world. I did join Ruffer straight out of university. And really the key for me has been, Ruffer has been a place where I've been able to learn to become a generalist investor. We're global, we're multi-asset. We have an unconstrained approach to asset allocation, so no set ranges. It's really been a very broad experience. And I started out in our private client team, learning how to build portfolios for private individuals. I learned a lot very quickly about portfolio constructing and investing in volatile markets. 2017, there was a big volatility shock. Obviously, the COVID crash in Q1. So there's been plenty of learning experiences on the way. And I started to move closer towards the investment side and working with the fund managers of a new fund that we launched in 21. And when I had the opportunity to join that fund management team, I jumped at it. And the rest is history, I guess.
Great, thank you for that. So if we could start off by looking at equities. In a world where valuations are the most popular yet best performing equities are very expensive, how do you go about building and maintaining a portfolio, and which types of assets do you want to own at this time?
So firstly, I'd say I agree with the comment that you just made. US equity markets are expensive from a valuation perspective, but also if you look at positioning sentiment, let's put some evidence behind that maybe. Equity risk premium in the US market. So the additional reward you're given for investing in stocks over bonds is at a record low. It's less than 1% for US equities. Now, historically, if you go back to the mid-80s, it's been about 2.5%. If you go back 100 years earlier, it's 6 or 7%. So investors really aren't being rewarded very much for taking on that equity risk. More traditional valuation metrics, price earnings is at pretty elevated levels. Cyclically adjusted PE ratios, so the CAPE is commonly talked about, the Shiller PE, that's at almost 40 times. Margins are at record highs. Investor positioning in US equities is higher than it's been any time in the last couple of decades outside of the global financial crisis. And clearly, we all know the point about concentration in US equity markets, which is pretty extreme. You can account for almost 20% of the S&P index by looking at just the top 3 stocks. Now, it's important to note that no one of those metrics are going to tell you what's going to happen with equity markets in the short term, but there's 2 things I would say. Firstly, that those valuation metrics are historically very good guides to your 5 and 10-year returns. So with starting points where they are today, those longer term returns don't look particularly attractive. And then secondly, they show that I think it's a fragile market and it is vulnerable to drawdown risks were something to come along and upset the soft landing narrative. So that's a problem. What do you do about it? I think you can look firstly for areas that do offer an attractive risk reward. So thinking about it from a geographic perspective, if you look at those same ratios or metrics, the CAPE or Shiller PE equity risk premium, the UK and China stand out on both of those. The UK is on about 15 times, China about 14 times. Similarly, the equity risk premia are about 5-6%. Understandably, there's a lot of good reasons for that, but it does tell us that there's at least some reward on the table for the risks that we might be taking on there. And then I think the second option investors have got, and something we think about a lot in the trust portfolio, is the ability to hold cash today with rates at sort of 4-5%. That's a positive real return, which is clearly a very different environment to where we've been. And perhaps using some of that yield to get exposure to other attractive risk premia, perhaps to the downside in equity markets. So I'm talking about derivative protections here that will make money if US equity markets do correct. S&P put options, exposure to credit spreads, so corporate borrowing costs rising. That's where I see a lot of asymmetry. You can buy some of these protections pretty cheaply, particularly credit protection, and yet they should give some pretty attractive payoff profiles if that certainty that investors have around US equity markets does start to become challenged.
And how do you stay disciplined in the face of markets working against your portfolio at times?
There's the obvious things around sticking to philosophy, process, really back to basics. What are you trying to achieve? And is the portfolio set up to do that? Clearly, we're asking ourselves that question pretty much every day. Fortunately, at Ruffer, there are a lot of people contributing to the same strategy because we only do one thing, and we've been doing that same thing for 30 years now. The key thing for us is to build a portfolio that's never trying to be absolutely right, and therefore the residual of that should also never be absolutely wrong. So what I mean by that is putting together a portfolio of assets that we think can make good returns if our core view around risks and opportunities is right, but make sure that there are other assets in the portfolio that point in a different direction and should allow us to deliver a return, albeit a less exciting one probably, if we're either wrong about the risks that we see or indeed we have to wait some time for those to crystallise. And that should hopefully allow us to continue to travel to the point at which our core assets are going to deliver the interesting returns. And it's a pertinent question because I think we're probably in that environment today. The portfolio is positioned defensively. We've got a view that as asset markets probably do need to adjust for where rates are today, and the kind of hyper-financialization that we've got creates a pretty fragile setup. But there has been a lot of momentum, and it's been the collection of different assets in the portfolio that has allowed us to continue to deliver a positive return, albeit a less exciting one, even though our core view has yet to play out.
And what do you see as a big risk to the seeming consensus that the US Federal Reserve has done enough to achieve a soft landing and avoid a recession?
Two key things, really: Trump and geopolitics. There's a whole load of things that we can point to, but these are the two that I would probably highlight. And they're the things that I think, depending on the path of policy, the economy, inflation, is the risk that we don't get the soft landing. When we think about the possible scenarios with Trump, certainly I can paint a picture of tax cuts, deregulation, sort of animal spirits, maybe even a restocking cycle at corporates ahead of tariffs being put into place. And that can easily probably lead to a reflationary boom, a good environment for corporates. But there I see the risk that can quite quickly become a problem for inflation. And you have a scenario where the economy is doing much better, but then inflation is stickier. Maybe that's the catalyst for a second wave of inflation, and clearly that's going to have implications for what the Fed can do around interest rate cuts. Given the people Trump is surrounding himself with, a reduction in the fiscal deficit, not as much fiscal support or spending that markets are currently hoping for, and with that, a sort of negative growth shock for the economy and for the financial system, that's going to push us more towards a hard landing scenario, more than a no landing that I just outlined. The point being here that there's a pretty wide range of possibilities for financial markets, and I think having a character like Trump with the policy uncertainty that comes with against this fully valued market backdrop, and actually, let's not forget, a very different backdrop to what we had during his first term as president, when you had a negative output gap in the economy, so spare capacity. The budget deficit was much smaller, 3% rather than 7%, where it is today. The Fed was expanding its balance sheet in 2016. It's contracting it today. Nominal GDP growth is already at 6%. It's double where it was in 2016 when he started his first term. And today, clearly, we've still got inflation above target as opposed to being at target as it was then. So I'd say altogether a more challenging set of circumstances combined with a lot of uncertainty. Trump is a key risk to that soft landing. On the kind of geopolitical front, again, I think potential for an escalation. You've had a lot of recent posturing from Putin, maybe a window where Israel feels a bit more emboldened to act, whilst Biden is a bit of a lame duck. But similarly, a de-escalation, I think, is on the cards. If Trump wants to broker some sort of deal with China, clearly that can boost markets in the short term and again lead to a pickup in global growth, but with it the risk of inflation. So my summary is that the tails are quite fat. You can paint a picture of a left or a right tail scenario, both of which would challenge the soft landing and current levels of equity markets.
Just how deep would a bear market in US equities have to be to make you become constructive on the outlook?
So for me, it's not about targeting specific levels. It's context dependent. The first thing I think about is what does the risk reward look like if you do get a bear market in US equities? Is that equity risk premium more attractive? Are valuations closer to historic averages? Have we seen a shift in positioning and sentiment, which, as I say, remains pretty stretched? And then it's looking at the shift, if any, in the fundamentals or the liquidity picture for financial markets. So were we to be in a scenario where, because of a fall in equity markets, you've got rate cuts, you've got an end to QT, you've got bank deregulation, which is going to free up some of commercial bank balance sheets, a more supportive liquidity environment, that's going to be an attractive point on which to take on more equity risk. Similarly, if it looks like a soft landing is sustainable, you've got better growth data, labour market has troughed, inflation has come back to target. If you have policy expansion as a response to a correction in equity markets, then that's a very different set of circumstances than we've got today. But if we're in a world where a fall in equity markets is driven by poor liquidity, falling earnings, rising inflation, higher rates, and they look set to persist, then clearly that's quite a different scenario and analysis as to whether we're going to be buying back into risk assets.
The Trust's largest equity allocation is currently the UK. Given that UK equities have had a difficult few years, what are your views on the likely catalyst for a sustained recovery?
Yeah, it certainly is the largest allocation on our fact sheet. I think it's worth noting that only half of that really is pointed towards domestic UK exposure. A decent chunk of that is really centred around commodity exposure, oil majors, diversified miners, which are listed in the UK. And that's really exposure held with the view that if we do have a more benign economic, geopolitical environment from here, then potentially you see a broadening out of equity markets and those more cyclical flavours and sectors could start to perform. Domestically, though, we do like the UK from a valuation perspective. As I've referenced, attractive equity risk premium, much more digestible PE multiples. Clearly, sentiment has been very poor. You did see it improve briefly and start to gather a little bit of pace post-election as the UK started to look like a relative politically stable place as opposed to, say, Europe, particularly France and Germany. Although that has faltered somewhat since the budget, with the perception that that's not particularly business friendly. Were that to shift, were policy starts to improve around that, that's going to help and act as a catalyst, not holding out a huge amount of hope there. But what you have seen this year is a lot more M&A activity. Foreign investors are starting to recognise the value in the UK stock market, particularly when contrasting it with US valuations. And if that was set to continue, you could start to see a bit of a re-rating. On the fundamentals, it looks reasonable. There has been a bit of a cyclical upswing in the UK, a reasonably strong consumer given real wage growth. If inflation can moderate alongside that, then that's going to be helpful. But I do think inflation, particularly service inflation, is sort of the sticking point. But with the piece on the budget, that's a pretty significant fiscal impulse. It makes up about 1.2% of GDP, with the peak of that fiscal impulse coming into 25, 26. If that can drive growth at a time when inflation is moderating, then clearly that's going to be attractive for the equity market.
You mentioned France and Germany earlier. Do you see valuation opportunities in European equities which remain below their US counterparts?
The market is clearly very focused on US exceptionalism. A colleague contrasted Europe and the US quite neatly by talking about SpaceX catching rockets with chopsticks. Meanwhile, the EU are forcing us to keep our caps attached to our plastic bottles, which encompasses the contrast quite nicely. But we know it is about valuation, it is about sentiment, it is about fundamentals, and they are in very different places. I think on an individual basis, there's some value to be found in Europe. One example we hold in the Trust at the moment is a packaging company, and they've got a very strong management track record. Clearly with packaging, internet parcels, e-commerce, there's kind of a structural tailwind there. They've just completed a merger with a US business, and they now trade on a significant discount to their US peers and are in the process of seeking a US listing, which would be a meaningful catalyst for the stock. More broadly in Europe, though, I think it's very vulnerable to those political gyrations that we've mentioned, and the macro does just look very challenging.
One of your colleagues describes China as the ugliest duckling in a portfolio of ugly ducklings. What do you see as the investment case for a country many think is uninvestable?
Yeah, so the ugly duckling idea is something that we wrote about in the annual report for the investment company. It really felt like quite a nice analogy for the collection of unloved risk assets that we own in the trust, one of which certainly is Chinese equity, but with the idea that we think they have swan-like potential characteristics. The case there is pretty simple. Valuations are extremely low on a discount to itself, but also wider emerging markets. Sentiment is dire. You use the phrase uninvestable. That to us screams opportunity. If investors are taking such a close-minded approach, we see that as potentially leaving some returns on the table. You can buy global leaders across a variety of sectors, but tech being one of them in China, at a fraction of the valuation of their non-Chinese competitors. And crucially, the authorities have now started to stimulate. They feels like they've really put a floor now underneath the equity market, and that provides a lot of asymmetry. So this for us is not about a shift in the fundamentals and the stimulus being sufficient to really fix the economy, but it's about a shift in sentiment, both domestically, which will possibly drive the first leg of the rally, and we got a glimpse of that in late September, early August. But then also potentially, if that starts to get going, it's going to draw in international asset owners, giving the significant underweights or, as you say, even zero allocations that investors have to this part of the market.
And do you think Japanese equities could struggle in the face of rising inflation and interest rates?
Yes, I guess the short answer. Look at August. The Bank of Japan raised interest rates by 0.25%, and the Nikkei was down 20% in 3 days. Yes, that was partially about a carry trade unwind, where a lot of the speculative money has perhaps left the building. But our bias is that there's probably a lot more where that came from. It's hard to really believe that the full extent of that carry trade, real money investors are going to have unwound those positions within the space of a week. What's interesting is Japan has the highest proportion of foreign asset holdings relative to their GDP of anyone globally. And what matters here is two things. One, is the Bank of Japan going to have to go again? And where are those foreign assets that Japanese investors own? Where are they held? I think the answer to the first question is yes. They very much still have a domestic inflation problem. You've got wage growth at 5%. We've seen that get quite political. And then secondly, where do they own those assets? It's US equities and credit. And that is why I think you started to see the S&P sell off almost double digits as the Bank of Japan did raise those interest rates. And, coming to the point around equity, it is what makes them vulnerable to that rising interest rate environment, with it an appreciating currency, which clearly affects the exporters. But we would rather get exposure to this dynamic essentially through the currency rather than through the equities.
Great, thanks for that. Bonds have had their worst month since September 2022 due to the possible inflationary impact of fiscal policies in the UK and the US. What do you see as the key drivers for bond markets over the next year?
Firstly, I think worth noting that it's not just been a bad month, it's been a bad 4 years, which is incredible given bonds are held up as the safe haven asset. Let's not forget that bonds have now been in a bear market since 2020, so that's pretty extraordinary. What's going to drive them? It's got to be whether we get a soft landing or not. It's going to be about government policy, central bank policy, which is largely going to be derived from the politics and where we get to on inflation, with tail risks, I think, both to the upside and the downside. We've got our lowest duration in the portfolio we've had for some time, which gives you a sense of where we think the risks are in terms of yields. I think there will probably be tactical opportunities along the way. We've seen a couple of times in the last year or so, once yields reached a certain point, thinking about US 10-year real yields, for example, going above 2%, that starts to become an attractive level. And we saw how big the move in yields was when markets started to wobble in early August. I think the other thing is not to focus too much on the next 12 months. I would be thinking about the role bonds have to play in a portfolio over the next few years or even decades. We think duration is going to have to be managed in a more dynamic way in the coming years. If we're moving to a wider set of possible outcomes, greater uncertainty and volatility around inflation, there are going to be times when you really don't want to own bonds in a portfolio and times where you do. So the role for nominal duration for investors, I think, is going to have a little bit of a rethink for the coming years.
Gold prices hit a record high earlier this year. Do you think the potential for higher for longer rates in the US could become a tailwind for gold prices?
I think In light of what the dollar has done this year and given where rates are, gold outperformed relative to those metrics. I think that's probably reflective of where investors are around what policymakers are doing, where deficits are, perhaps where inflation has been. The fact that deficit financing probably is going to be the key for growth in the coming years. And there's a desire from investors to own something that governments or central banks can't create more of. I also think probably the run-up in the gold price ahead of the election was a bit of an uncertainty trade. It doesn't really feel like it now, but pre-election it was quite uncertain. It was, very closely contested. And probably the reason gold has fallen away a bit over the last few weeks is a little bit of a pullback in response to that uncertainty going away. Central banks, though, have been such a key driver of the gold price over the last couple of years, particularly China have been huge buyers of bullion over the last couple of years, really in response to what the West did around confiscating Russia's dollar reserves. Gold has become a really key safe haven asset for global central banks as a way of moving away from US dollar assets. And I don't think that's changed. I think that will continue to be a support for the gold price, and therefore it can continue to be an interesting structural asset in portfolios. But to your point, record high prices until very recently, that does create some cautiousness or some vulnerability in the short term.
And within precious metals more generally, what do you see as possible diversifiers to gold?
I think as a diversifier from the metal itself, gold equities are interesting. You can get a bit more comfortable in valuation terms. They've had improving margins. They've demonstrated better sort of capital discipline over the last few years. They don't need the gold price to necessarily go up from here to re-rate and make investors good money. They'd probably perform quite well in an environment of a stable, i.e. not falling gold price. But you can also look at the other precious metals, silver, platinum, bullion, the extensions or derivatives of the gold price, and historically have had much higher betas, sort of 1.5, 2 times the gold price moves. We've used them to an extent in the trust portfolio in the year to date. Silver to much greater effect than platinum perhaps, where positioning has been a lot less extreme. But they're also quite nice to have in the portfolio because of their characteristics, really just as industrial metals as well. They have a practical use beyond gold, which is typically just used for jewellery. So they can fit into that role as a play on if we do see an extension of the economic cycle. And also in both cases, the fundamentals are quite appealing. So just from a demand and supply perspective, for example, the platinum price really suffered when investors got very excited about the shift to EVs, because platinum is a key input into catalytic converters, which are used in internal combustion engines. So if they are no more, then we no longer need as much platinum. But with that EV narrative slightly coming back to reality, plus the fact that platinum is an input also into hybrid vehicles, there's an interesting few demand characteristics there, and supply remains pretty constricted.
One final question for you. When I chatted with a couple of your colleagues a year or so ago, they thought that equity markets were more likely to deliver high single-digit returns over the next few years than some of the stellar returns we've had in recent years. Do you still think this is the case?
I think this is only wrong if Trump can drive some sort of structural uplift to corporate earnings and profit margins, effectively by doing what he wants to do and drive US exceptionalism and fund it with the rest of the world through tariffs. That's how I think you can justify a CAPE ratio of 40 times today, why perhaps you wouldn't get a historic mean reversion. I don't think that's an impossibility, but it probably does ignore the bigger picture. We've got a volatile character assembling what I would call probably a pretty bizarre cast of characters against a very fragile and very different backdrop. When we think about the political environment, the economic environment, the liquidity backdrop, the deficit position, all those sort of metrics that I referenced. And I think it is quite likely that today we have been borrowing from future returns. The range of plausible market scenarios is wide and getting wider. We're clearly living in a multipolar world, and I think it's going to be defined by more volatility, more inflation risk, and investors probably are going to have to think beyond US exceptionalism and start to use and apply a wider ranging and flexible toolkit if they want to protect and grow portfolios in the coming years. I don't think it's going to be as simple as Trump will fix it. And that's certainly what we're thinking about in the portfolio today.
And on that note, Jasmine, thank you very much for joining us today.
Thank you very much.
If you'd like to read more market insights, please head over to the Kepler Trust Intelligence website, where you'll find recent articles on the likely sector impacts of Trump's victory and allocation ideas from our panel of experts, amongst other things. We hope you join us again next month for another episode of Market Matters.
Past performance is not a reliable indicator of future results. The value of investments can fall as well as rise, and you may get back less than you invested when you decide to sell your investments. It is strongly recommended that if you are a private investor, independent financial advice should be taken before making any investment or financial decision. Please be aware that there can be a time lag when we release podcasts, meaning time-sensitive information may no longer be accurate at the time of publication. Kepler Partners LLP has a relationship with some of the companies covered in this podcast, which may impair its objectivity. Kepler Partners LLP is authorized and regulated by the Financial Conduct Authority.